hour by focusing on the market and really the way forward. We have Gautam Baid, equity advisor at Complete Circle Stellar Wealth, with us. Gautam, great to have you on the show as always. So you tell us, if there's one thing that the last 2 weeks have taught us, that every time the market gives a dip, buyers rush in, and we've seen what that has, translated into just in terms of the domestic inflows coming through. What is your stance now? How do we navigate this market where dips have become very, very shallow?
Hi, Surabhi. Hi, Rima. Thank you for having me on your show. It is true that valuations in the broader market have become pretty expensive. So one needs to be very cautious and selective and have a bottom-up approach to stock picking from here. The price to book of the mid-cap and small-cap index is now more than a decadal high. So the broader markets at an index level definitely has become expensive. So from here on, to generate alpha, bottom-up stock picking is going to be the name of the game. And at this particular juncture, I would like to share that a very important lesson from the last 16 to 17 years of investing in the Indian markets during such times of exuberance and euphoria in the small cap space. This is the time when you have to be very conscious of the quality of companies entering your portfolio. And one must resist the urge to go down the quality curve in the lure of quick short-term returns. That's very, very important. The quality of the portfolio should not be compromised at this particular stage.
Okay, so do not compromise quality for short-term gains. That's advice well put. Gautam, morning. So every time we chat with you, you give us some important, nice stocks that investors can keep on their radars. Today, you're telling us about Aarti Pharmalabs. Now, this is the demerged entity of Aarti Industries. This demerger happened about 15 months back. Aarti Pharmalabs listed on the stock exchanges sometime last year, 30th of January, at a price of 377, and now it's at 488. So it's given a good 30% return. So first, tell us a little bit about Aarti Pharmalabs. What does the company do?
So Rima, Aarti Pharmalabs is basically into three main segments. 55% of its revenues come from xanthine derivatives. 40% comes from APIs and intermediates, and 5% comes from the CDMO business. And this company fulfills many of the parameters that we look for while selecting stocks for our PMS. Firstly, it has got good parentage. So like you rightly mentioned, Aarti Pharmalabs is a spin-off from Aarti Industries. So you get the good parentage of the Aarti group. Secondly, this company, Aarti Pharmalabs, exports to the higher margin regulated markets of US, EU, and Japan, whereas another Aarti Group company, Aarti Drugs, that company exports its products to lower margin unregulated markets. So one of the things we look for when selecting stocks is the potential for valuation re-rating. Aarti Drugs is trading at a trailing P multiple of 29 times, whereas Aarti Pharmalabs, which is a more superior business, is trading at a trailing P multiple of 24 times. So there is a potential for valuation re-rating. Another aspect we look for while selecting stocks to invest in is that the business should have less cyclical revenues and be present in an area of long-term structural growth. 55% of Aarti Pharmalabs revenues come from xanthine derivatives, which find applications in nutraceuticals, cosmetics, pharmaceuticals, and beverages. So this makes it more like a proxy FMCG play. So the revenues are less cyclical. That's one more thing. Another thing that we look for is the potential for optionality. As of today, 5% of Aarti Pharmalabs revenues comes from its CDMO segment. But as the proportion of revenues from the CDMO segment continues to go up over time, that will lead to a further valuation re-rating for this particular business. And finally, the fifth and important parameter we look for when investing in businesses is prudent capital allocation without having to resort to dilution of equity. Currently, Aarti Pharmalabs is undergoing a 500 crore capex in its Gujarat plant, and that entire capex is being funded by internal accruals. The management has guided for 12 to 17% EBITDA growth over the next 3 years, and given the valuation comfort, there is potential for healthy double-digit returns from the current market price. The key risk with this business is the regulatory risk, which is present in all pharma companies exporting to the regulated markets. That is, any adverse observations coming from the inspection agencies of US, EU, or Japan.
Just for the benefit of our viewers and to keep the conversation real, so xanthine, and the company gets about 50% of its revenues from xanthine derivatives. So xanthine is basically caffeine. So,
Okay.
in coffee that you drink, caffeine is naturally occurring. But in your cosmetics, in nutraceuticals, or even in your beverages like Coke and Pepsi and for all the other soft drinks, the caffeine which is there is a synthetic compound. So those are the xanthine derivatives, and this is a company which gets about 50% of its revenues from xanthine derivatives by supplying it to the beverage industry, nutraceuticals, as well as the cosmetic industries. So that's just a word on what xanthine derivatives is.
Okay.
It's a synthetic compound of the naturally occurring caffeine.
Caffeine, all right. But I think for in our coffee, we still need the original organic caffeine. But I know xanthine, as you explained, Rima, that will find a lot of uses across different industries and segments. That's an interesting one, Gautam. Just run us through the other stock that you've picked out as well, which is Apollo Pipes. And my first question here is that lots of listed pipe makers in India, right? There's Astral, there's Phenolix, there's Syntex also, which is doing pipes. So a lot of competition. So why Apollo Pipes?
Well, Surabhi, Apollo Pipes is an emerging player in the Indian plastic pipes industry. And among all the peers that you mentioned, this company grew its revenues at the fastest pace between FY18 and FY23 compared to its other listed peers like Phenolix, Astral, Supreme, and Prince Pipes. The current year revenues of Apollo Pipes is expected to be around 1,000 crores for FY24, and the management is aiming to triple revenues to 3,000 crores by FY28 over the next 4 years. They plan to accomplish this through doubling their existing production capacity to 286,000 metric tons per annum. And this should help drive 30% volume growth over the next 4 to 5 years. And the company also plans to leverage the reach and recall of the APL Apollo brand. Now, it is not sufficient to just focus on the revenue growth of a company. The quality of earnings and the trajectory of the quality of earnings is equally, if not more important. And there are 3 reasons why the quality of earnings of Apollo Pipes is expected to improve substantially from here. Firstly, the focus is on improving the share of non-agri value-added products like CVPC pipes and HDPE pipes in the overall revenue mix, because as of today, agri constitutes 42% of company revenues, and that's a low-margin business. So as the low-margin business becomes smaller over time as a proportion of overall revenues, the valuation re-rating should continue. Secondly, as of today, Apollo Pipes derives 70% of its revenues from North India. So there's a lot of geographical concentration risk. But the new plants and distribution expansion in eastern parts of India and southern parts of India over the next 3 to 4 years will help de-risk the business model of the company. So again, the quality of earnings will improve from there as well. And thirdly, the company is focusing on improving the proportion of cash sales as a proportion of overall sales mix. And the management is guided to bring net working capital days down from 55 days currently to less than 40 days in the next 3 quarters. And as we know, because working capital is a part of capital employed, as working capital requirements go down, your capital employed goes down, and therefore your return on capital employed or ROC goes up. So the quality of earnings of this business is also improving, driven by these 3 factors. The stock currently trades at 26 times FY26 earnings, and we expect these valuations to sustain. The 2 key risks with this particular business is firstly the execution risk associated with the capacity expansion, and number 2, like you rightly mentioned, it's a very highly fragmented industry, so there is always the risk of intensifying competition from organized and unorganized players.
Fair point, Gautam. And you mentioned both of these are in your portfolio, right? Just checking for the sake of disclaimer, both these stocks?
Yes, sir. We hold both these stocks for our clients and our PMS.
Okay, all right. Great having you on the show and, getting some of those insights on these interesting companies. Thank you for joining in, and we look forward to the next conversation. Well, with that, we do have to take a very, very quick break. Come back on the other side and we'll focus on commodities. Today, Manisha is looking at gold. We'll find out why.